Hi, and welcome to Macro Monday, where we talk macro and try to make sense of markets that really don't make any sense. I'm your host, Steven Van Metre, and I have a special announcement. For those of you that watched the Sunday show and you asked for it, now with 100% more Bitcoin. That's right, I actually found out I can chart Bitcoin. Didn't know I could do that, but we've got it. For those of you that watched the Sunday show, please stay tuned to the end. I've got some updates, and I really appreciate your feedback. And we'll look at Bitcoin. How about that? We'll give everybody what they want, which is more Bitcoin. Now, some of you go, well, I don't want more Bitcoin. Well, okay. Well, there are people out there that do. In answer to your question, some of you pointed out that I looked like a blueberry last week, and I did. I didn't realize that the bulbs in my new lights have a blue tint to them, so I've turned them the other direction, put the older lights up in front of me. I have no idea if this is better or worse, but that will be what that is. Now, some of you pointed out that some of my videos are a little bit blurry, and others of you have pointed out, go to your settings and upgrade, because we are now in 1080. That's right, so give that a shot. So why do the banks tighten financial conditions? We saw this in late 2008, and we're seeing it again now. Now, many people saw this, okay, well, last quarter, this COVID thing and whatever is going to go away, and the banks are going to really ease financial conditions. They're going to lend. Well, then doesn't appear that way, at least underneath the data, which is just being interpreted as, well, they're going to. They're just nervous. Well, there's really a bigger picture to this. If you look at interest rates, right, let's go back to, say, 2008, and here we are in here on the weekly chart. And what happened is interest rates fell, and that means financial conditions tightened, and banks backed off on their lending until some things changed. And those two things that changed was either support from the Fed by more easing or federal backstops against loans defaulting. Banks don't inherently like lower interest rates. We'll go through this a little bit deeper. So look here, following March, interest rates dipped. They haven't really improved at all. If we look at where Treasury yields are at least on the long bond. But yes, only everyone thinks, oh, well, rates are going to go down. Go up. No, they're probably going down, and I suspect that financial conditions are still tight. Maybe they're not as tight, but the lending data is saying that financial conditions are tight. Now think about it from the bank's perspective. Because you can look at it from a charting perspective, you look at it from a macro perspective, but sometimes when you're having trouble with something, what I do is I just flip it the other way. How about from the bank's perspective? How does a bank make money when they lend? Well, there's fees and all that junk, but what's their primary way of making money on a loan? The interest, right? That is their gross profit, not their net profit. Their gross profit before expenses is the interest. So let's say that you were going to lend money out at 1%. And you're going to do it over, say, well, no, you know what? Let's use a mortgage rate. 30 years, 3%. That's roughly what the 30-year rate is, so we'll just use 3%. If you're going to lend someone money for 30 years at 3%, granted, your gross profit on this is narrow, right? Because there's not a lot of interest there. But what do you need as the bank? What is your most important thing about that loan? What is it you need? You need all your money to come back. Because if that borrower defaults, yeah, okay, you're going to get the property back. Maybe they put 20% down, but what if home prices fall? Your margin for error is super duper thin. So why would you tighten lending standards when interest rates are falling? Because you only want to lend to the people you're really super sure are highly likely to pay you back. Now let's say that 30-year mortgage rates were 30%. I know some people go, what? No, but just pretend, right? Because there's so much interest, and that interest is front-loaded in a amortized loan, if people defaulted on it, now what is the bank going to do? Oh no, I'm so many people default. I'm hurting. Oh no, feel bad for me. Yeah, and then you're like, wait a minute, they're making out like a bandit. They got all this interest up front before the people defaulted. They repossessed the house, and in an inflationary environment, right, where yields are rising, the bank sells the house for more money. But in a low interest rate market where deflation is more likely to happen than inflation, the banks got a lot of risk. They don't want to repossess that home if the homeowner defaults and have to find out that they're going to put it back on the market and sell it when prices are falling. So why are banks constricting credit? It's simple. They're not making any money. And those who are willing to lend you, they need to make sure every bit of that interest gets paid back. And so they tighten lending standards. They really start caring. Do you have a job? Are you making money? Are you living on your overtime? What are your bills? What are your debts? What is going on? And when you understand that, what it takes to make the banks happy. Now, long term, we will all agree that banks need interest rates to be higher. Not going to happen. Why is that? Because when interest rates go up, financial conditions are going to tighten. All right, come on, Steve. You can't tell me that financial conditions are going to tighten if interest rates go up and down. Well, what is wrong with you? Can't you make up your mind? Yeah, they tighten because it leads to lower lending growth. Look, do you think if 30-year mortgage rates went to 6%, you'd have a whole flurry of people borrowing money? No, you wouldn't. That is the problem with this whole system, is financial conditions are tight until people come out and borrow. And right now, higher interest rates aren't going to get people to borrow. So banks know interest rates going in one direction. That is, they got to go down. And what do they need to do? They need to get the Fed to do more QE to push rates lower, right? I mean, everyone's betting against the bond market. They need to push them lower. What else do they need? They need the federal government to step in some form or another and put some sort of guarantee on these loans. Then the banks will lend, because at that point, if you're lending out at these super low interest rates and you can strip the risk away, well, all of a sudden the banks will lend. That's all they're waiting for. So that is why. I hope this helps you understand part of the reason. Is this the only reason the banks are tightening lending standards? No. But is it a big part of it? Yes. So anytime you're struggling with why is something happening, try to put yourself in the other person's shoes and see how the world looks from their perspective. And then you make sense. Yeah, I probably wouldn't go lend someone. Would you personally go lend someone, money for 30 years at 3%? No way. Well, now you're a bank. Right? Doesn't sound very appetizing. Much rather do it at 30%. Hey, 30 years at 30%? I'll probably be willing to do that. Because again, I can spread my risk out, and I know some people are going to default, but I can repossess the asset. I'm making enough on interest that I can resell that asset and still make money, and then I'll cry and sob about how, people are taking advantage of me, but, welcome to the banking world, right? All right, let's take a look at the macro data. Not a whole lot today, but there is some to look at. And we've got the Chicago Fed National Activity Index, which came in at 0.79. Now, last month it was 2.54, which was completely off the charts, and even 0.79 is super high. So if you go to the Federal Reserve Bank of Chicago, and what you find out is at 0.79, a zero value for the index is associated with the national economy expanding at its historical trend. So what does that mean? We're at above trend growth. See, it says kind of right there, above trend growth. And a negative value are associated with below average growth. The problem is the direction of the growth is headed down. And we can see even inflation cycles here. So they even look at the 3-month moving average, because even the Chicago Fed says, hey, this index is super noisy. But everyone looking at inflation, the 3-month moving average says that you would need the index to be over 0.7, which it currently is at 3.05. But check this out. You would need it above 0.7 more than 2 years into an economic expansion for an increasing likelihood of a period sustained increasing inflation. So there you go. The answer is, if this thing is headed down, so if the headline index is headed lower, that means the moving average index is headed lower, and that means inflation expectations are also headed down. They do one with the business cycle, and then there's a diffusion index, so you can see on a month-to-month basis, it too is rolling down, and it makes sense. This thing is just way off the charts. I mean, and if you zoom it back, you can just see the thing doesn't really go way up like it did. So reality is inflation expectations and the Chicago Fed National Activity Index are coming down. All right. Back to investing.com. Producer prices came out from South Korea on a month-over-month up to 0.5%, but still on a year-over-year basis, minus 0.5%. South Korea is exporting deflation. Yeah, it's improved from 0.8, minus 0.8, but still exporting deflation. Let's take a look at how the hedge fund managers are positioned in the futures market. Not a lot has changed, but there's one very interesting chart in here. We see on the 10-year virtually no change. Hedge funds and speculators are they're very slightly net long. The 30-year, they're still very, very much net short. This small move higher is not a meaningful change. They're still heavily betting. The market is heavily betting that 30-year rates are too low and are going to head significantly higher. The lending data tells you that is very not wrong. The lending data tells you that interest rates are too low, not too high. The market's betting on the wrong side of this and will eventually be proven wrong. How about in crude oil, West Texas Intermediate, small increase in the net longs, but the trend has been speculators are backing off this as we go into the fall and winter months. How about the S&P 500? No real change there. Slightly net long on speculative positioning, but we're not there yet. I thought this was the NASDAQ. How about the euro? Remember, the euro is a big component in the trade-weighted dollar, and people say, well, the dollar can only go lower. Well, when you have the largest speculative long position in the trade-weighted dollar, which is for the euro, right? So in the trade-weighted dollar, you've got a big piece of it is the euro, and you've got this massive speculative long position. It's likely going to head lower, and that's going to bring the dollar higher. So we're seeing what looks like a topping pattern in the euro and in speculative long positions. How about gold? No real change there. Gold, very sensitive. Usually it changes in the dollar. Many people say this time it won't be. I still think it will. We'll see. But look at this NASDAQ. Now this Hedgeopia, who does a fantastic job of these charts, doesn't go back when he posts them, but there were charts on Twitter showing going back to 2008 that this is the largest short position since 2008. And all of a sudden, hedge funds went, just crazy short the NASDAQ, which is pretty wild to me. See if that plays out for them or not. Only time will tell. The Russell 2000, they're still net long on small caps. And as far as the U.S. dollar, they increased their short positions on the U.S. dollar. So massive bets against the U.S. dollar usually end up in a higher dollar, not a lower dollar. So look for that to come, as I suspect it will, potentially within a month. And then we have the volatility index. No real change here, as again, speculators are betting the volatility is going to stay low and head lower. This is another way that investors use the market to prop up asset prices, and they do that by shorting volatility. All right, so let's go hit up a couple of charts. Some of you have asked about the S&P 500. Now, if you've tuned in Sunday, I want to answer some questions on that, but let's just hit a few charts real quick and take a look at what's going on. Remember, if you're not in 1080, switch up to that. It will make these a lot clearer. All right, let's take a look at the S&P 500. Everyone's suddenly panicking. Oh no, the market's selling off. Well, look, it went on some massive, ridiculously rally in the midst of a recession and a pandemic, and now people are worried. Maybe they should have been worried that we're bidding stock prices up when inevitably corporate profits are going to head lower. But if you're heavily invested in equities, just remember that the big trend, the big support level here is right around this 200-day moving average, which on the S&P 500 is 31. Let's just say 3,100 right now. So could it come back down to its perhaps June lows? Yeah, sure could. And does that invalidate the trend? No, it just means that people said this thing was going to continue going higher, and nothing continues to go higher forever. How about tech stocks? Same point here. Looks like the major support level is the 100-day moving average. On the NASDAQ, that would be 10,447. On the Dow, major support probably is right around we'll just say this level here of 26,600, somewhere right in there, maybe even a little bit lower down to its 200-day moving average at looks like 26,250. And small caps, again, looking for some sort of support here, but there's a convergence of its two moving averages. So everyone that's all of a sudden turned massively bearish, hang tight. It doesn't mean markets are going higher, just people are going to buy the moving averages. The notable thing to me today was on the VIX. Remember, I've been saying 31, you get a move over 31 and things are going to start falling apart. Well, it did get back up over there early September. Market participants quickly reversed it, probably very smart given their positioning in the market. Today it tagged right over 31. We can zoom in today, and boom, just touched right over 31, and sellers put the top right back on Pandora's box and slammed it lower. But look, the trend in volatility is suggesting, just a price trend here is suggesting that this thing's going to get over 31 at some point, and all bets are off. And one thing that I have looked at is the effect of quantitative easing on volatility, and it is quantitative easing leads to higher volatility. A lot of people don't get that. They think it leads to lower volatility. It doesn't at all. And keep in mind, we're heading into the month and quarter end, and there's I think around $200 billion of equities that are going to be need to be sold to buy stocks. So that's not conducive of what's coming in the end of the next week or so of trading. Let's take a look at Treasury yields. Again, markets pushing up. The trend lines really tell you that there's a bullish picture here now, but from my thesis, we should eventually see lower Treasury yields. And many keep asking, what are you really watching for? I'm looking for 30-year yields to break below and move down from 1.2% probably pretty much to zero. But we're seeing, just people hammering the sell button on Treasuries just to keep it alive. And there you have, all this selling coming right in here. But look, back in, looks like July, you saw all this selling here, and what it meant was that once the sellers were exhausted, it meant there was a bullish run. I mean, people are fighting against the Fed here, and it just is what it is. Probably a big mistake. Let's take a look at Bitcoin, because I promised 100% more Bitcoin in this video than anyone else, or any other video, not more than anyone else for sure. So here's Bitcoin. Again, didn't know I could chart it. And many of you have asked, they said the background looks weird, change it to white. I want to show you, for those of you that tuned in Sunday, I did listen to your comments. Here's what a white background looks like. And if you thought blue was unreadable, to me, that's even worse. I tried some different colors, but as someone pointed out, switch over to 1080, give that a run and see if that works out for you. Some of you said, hey, this isn't really valuable. You're just talking moving averages. That I understand that. Some of you said do more technical analysis. And here's the thing. Some people really don't believe in TA. Some people do. And there are some very good professionals out there that do TA all the time. And the reality is they're all behind paywall. So this is kind of free. But I also not only do I look at price, I look at momentum, which is the change in price. And that's something you have to manually calculate. So it seems like the response was pretty good, except I didn't cover which ETFs, what the short and medium term indicators were, what all the colors on the line, the chart were. I get it. Thank you for the feedback. I'll work on that. And some of you have suggested, look, maybe do a smaller number of ETFs and focus on the broad ones and put more effort into that. Great idea. So let's do some quick analysis of Bitcoin. It is very bullish pattern here. And for those of you who are not interested in what I'm about to do, then I will see you on Wednesday. But here's the trend line of Bitcoin. And from a technical picture here, there's some danger in this view, because what you have is a potential uptrend line that's being broken, and it hit that uptrend line and it got rejected. It's not something you normally want to see. Now, from a moving average standpoint, is this thing bullish? Yes. I mean, you've seen all the moving averages headed higher, but remember, moving averages are lagging indicators. They are absolutely lagging indicators. Now, how about we add some more lines for those of you who enjoy that? And where's the price line? No, that's not the company. It's my price line, my price tool that puts a price line in. Go figure. So you've got a level of what's called resistance here, which it hit. And your next level of resistance is going to be right underneath that. So we'll switch over and copy this tool and drag it down. So now you have what looks like here, a sell zone for Bitcoin. And then what do you have below? Is this kind of cool that we're doing this live? Maybe some of you value this, even if you're not interested in Bitcoin or don't trade it. I don't trade it. I don't own it, but maybe you find it interesting. And then you kind of have what looks like the buy zone being down here somewhere. and we can draw a line, and you can feel free to critique me and tell me how wrong I am about this. But I would say from right here, this is a sell zone. This somewhere right down in here is a buy zone, and maybe this line comes up a little bit, somewhere right in there to make them look more symmetrical. I don't know. But anyways, it tells me that the short-term picture for Bitcoin potentially is bearish because it's being rejected here at this sell zone, but there's a buy zone down here. The moving averages are headed higher. So there you go, 100% more Bitcoin. And for that, I am going to put on the crown because, you know, I am Bond King, and I enjoy having all of you as my fans. I look forward to all the comments, and I have been going through the comments for our special guest. I wrote a whole bunch of hard-hitting questions, many of them based on your comments and your questions. And so I've reached out to him, and we're working on getting the schedule. I am not going to tell you who it is, but I know you're going to love it. I can't wait for it. I'm super excited. And so be sure to like and subscribe and let me know in the comments what you think, good or bad. And if I look blue today or what, we'll keep working on that. I'm Steve Van Metre. Thanks for watching. I'll see you on Wednesday. Bye now. The content of this video provides educational information only. It's not intended to provide investment or advice. It is not to be construed as recommendation or solicitation by selling security, financial instrument, or participating in particular trading strategies. Video was prepared by Steven Van Metre on personal capacity. Opinions expressed in the video that do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial. Boom.